December just told us more about the 2026 housing market than most of 2025 did. Inventory got cut in half, buyers kept writing offers, and prices refused to roll over, even with rates in the 6% range. In this video, I'm breaking down what the data actually says about supply, demand, and pricing in San Diego. I'll also cover why this market feels tight even when sales are down and what that means heading into Q1 of 2026. Because if you're waiting for clarity before making your next move, this is where it starts. The full San Diego data and more coverage here in this week's San Diego Market Matters, and I'm Karl, your San Diego realtor. If you haven't liked and subscribed yet to the channel, here's your chance to do it now, or you can wait till the end. Either way, I appreciate you being here and watching. Now, let's jump into this. First, let's start with new listings because this is where the foundation of the 2026 market is being set. December is always a slower month, but what we saw here goes far beyond normal seasonality. In December of 2025, only 251 detached homes came to market compared to 977 in December of 2024, which, by the way, 2024 was a record low year. That's a year-over-year drop of more than 75%. On the attached side, we saw 173 new listings, down from 562 the year prior and a decline of nearly 70%. That's not noise, that's a structural signal right there. And what matters even more is that this wasn't isolated to only December. If you look at the monthly year-over-year change, you see that since March of 2024, the growth rate in new listings has steadily been deteriorating for both detached and attached homes. Earlier in the year, listings were still up year over year, but by late summer, that flipped negative. And by Q4, that pullback accelerated sharply. Month after month, fewer sellers chose to come to the market compared to the year prior. Seller participation didn't just slow down, it hit a freaking wall. Now, here's the part that most headlines completely miss with the San Diego market. This pullback in new listings happened while mortgage rates were slowly drifting down and settling into the low 6% range. Now, in theory, lower rates should have encouraged more sellers to list, especially since most sellers are also becoming buyers. But the data shows that that didn't happen. That tells us that these 6% interest rates still aren't sexy enough for homeowners that are sitting on much lower rate loans to make a move. Clearly, in San Diego, rates alone are not enough to unlock supply, at least not yet. From a market structure standpoint, this is critical. Fewer homes are entering the market, and at the same time, more buyers are becoming qualified again. And that imbalance doesn't cause a crash, it does the opposite. It creates competition. Now, don't run away with that idea just yet. Even with declining new listings, San Diego did not experience meaningful price growth in 2025, which we'll cover shortly. So as we move into 2026, the most likely outcome is not a surge in prices, but prices staying relatively flat. And that's where this selective pressure comes in. The best homes, the ones that are well priced, they're well located and in good condition, those are still gonna move and they're gonna command stronger pricing. While the rest, they're just gonna sit around. And this dynamic is happening across both sectors of detached and the attached housing markets, which removes the usual pressure relief valve. Buyers can't simply shift into another category to find supply. So unless we're meaningfully going to increase new listings, this market is gonna stay constrained. Not frozen, not overheated, just structurally very tight. While new listings tell us what's being added to the market, active inventory tells us what's actually available to buy. It's the total number of homes on the market at the end of the month, including anything that carried over from months prior. And this is where the structure of the San Diego housing market really becomes impossible to ignore. As of December, total active inventory fell to 1,876 homes county-wide. That breaks down to 1,027 detached homes and 849 attached homes. Year over year, that's a 55% drop for detached inventory and a 45% drop for attached inventory. Those are not seasonal moves. That's a sharp contraction in supply. What's even more striking is when this happened. Inventory didn't suddenly fall in December. It's been declining steadily since March, after peaking in spring and early summer. By the time we reached the end of the year, inventory had retracted almost the entire 2025 buildup. And you gotta look at how compressed the market has become. Detached and attached inventory, it isn't equal, but they're closer than normal. In December, the gap between them was less than 200 homes. That's not typical for San Diego, where the detached inventory usually dominates the portion of the market. This tells us that supply constraints isn't isolated to a single category. It's happening across the freaking board. Now let's layer in months of supply, because this is where the tightening really shows up. In December, months of supply dropped to 0.8 months of detached homes and 1.3 months for attached homes. Year over year, that's a 56% decline for detached and a 41% decline for attached. We have not seen supply this tight since late 2021. And the trend matters just as much as the level. Months of supply for attached homes has been falling since March, and for detached homes since April. That confirms what we're seeing in the raw inventory numbers. Supply isn't stabilizing, it's tightening. Now here's a key distinction. Back in 2021, when we last saw supply this tight, mortgage rates were under 4% for most of the year and into early 2022. Today, rates are sitting closer to 6%. So when inventory behaves like 2021 in a much less affordable rate environment, that tells us that this is not emotional, it's not seasonal, it is purely structural. Which brings us to seller behavior. Despite ongoing headlines around inflation, employment concerns, and economic uncertainty, sellers are not rushing to the market. And one of the most overlooked reasons is pretty simple. Many homeowners aren't seeing anything that they want to buy in the current standing inventory. If you don't like what's available, you don't list your home. That creates this feedback loop. So low inventory discourages move-up sellers. Fewer move-up sellers keeps inventory tight, and tight inventory keeps the market structurally constrained as we move into 2026. It's this vicious cycle. So when you step back and look at active inventory and months of supply together, this doesn't describe a market in distress. It describes a market that is restricted. Now, supply is only half the equation, because the next question is how buyers are responding to this environment. And that's where the pending sales data starts to get really, really interesting. Now moving into pending sales, because this is where all of the previous sections really come together and connect. Pendings are simply the number of homes that went into escrow that month. So this tells us how buyers are actually responding to the inventory that's available, and not how they feel, not what headlines say, but what they're actually doing with the real options in front of them. And when you line this up with the new listings and active inventory, the picture gets very, very clear here. In December, detached pending sales came in at 907 homes, which is up 4% year over year. And remember what we just covered in the new listings data. In that same month, we only had 251 new detached listings hit the market. So even without getting overly technical here, the point is simple. Detached demand absorbed more homes than sellers replaced. In other words, more detached homes went into escrow than what came to market. And if you want a clean way to visualize why this felt so tight, we can break this down a little further. We ended November with 1,458 detached homes on the market for sale. We only added 251 new detached listings in December. And then we had 907 detached homes go into pending in the same month. That's a massive bite taken out of an already shrinking shelf of inventory. Buyers didn't suddenly have more choices, they had fewer, and yet they still moved forward. Now, attached homes tell a slightly different story, but not a concerning one. In December, attached pending sales were 447 homes, which is down almost 11% year over year. And that makes sense given what happened to supply late in the year. Attached inventory tightened up hard. Affordability is more sensitive in this segment. And when you layer in HOA dues plus mortgage rates still in the sixes, attached buyers tend to get picky a lot faster. A lot of them will pause instead of forcing a deal on something that doesn't fit. That's not buyer fear, that's just buyer sensitivity or selectivity. Now, let's zoom out to the full year, because this is the part that matters for 2026 expectations. For detached pendings, 2025 finished 14,880 pending sales year to date, and in 2024, it finished 14,887. That's basically identical, pretty much flat. So the detached demand did not disappear in 2025. Now, for attached pendings, in 2025, we finished off at 8,027 compared to 8,311 in 2024, which is down 3.4%. And again, given how tight attached inventory got in the later part of the year, I don't view that as some major warning sign. That's consistent with a market where the attached buyer is more payment sensitive and more selective. And this is why December is such an important snapshot. By the time we hit December, active inventory was down to 1,876 total homes on the market county-wide at the end of the month. And at the same time, we still had 1,354 homes go independent in December alone. And that's when you combine detached and attached. So in detached, we had 907 and 447 in the attached. That's why it fell so tight during the month of December. So when you connect all of this, the takeaway is simple. Buyers are still there. They're just operating in a market with less supply and making more deliberate decisions. Detached homes are being absorbed quickly because supply is thin. Attached homes are seeing more hesitation because affordability and choice matter more in that segment. Either way, this is not a market where demand has vanished. Rather, it's a market where demand is being filtered by affordability and constrained by supply. And that brings us to the next layer of the story. New listings are shrinking, inventory is compressed, pendings are holding up. So the next question becomes, how many of these pendings are actually making it across the finish line? And what does this tell us about pricing and leverage? Which brings us to closed sales. Now, this is the part people love to point at like it's a scoreboard, but you gotta remember one thing here. Closings are a lagging metric. These are the deals that were put together weeks or even months ago, and they're just now finishing the race. So with that said, here's what December looked like. On the detached side, we had 1,111 closed sales in December, which is slightly lower than last year's 1,143. That's about a 2.8% dip year over year. Not a collapse, not some dramatic drop, just lower. And it makes sense because we've been watching supply tighten for months now. On the attached side, the drop was more noticeable. We had 562 closed sales in the month of December compared to 642 the year before that. That's down 12.5%. And honestly, that tracks perfectly with what we've been saying. Attached buyers are more payment sensitive, HOA dues matter more, and when choices get thin, they're more likely to pause instead of forcing a deal to work. Now, if we zoom out to the full year, and this is where the story gets even clearer, detached closed sales for 2025 was 14,736 compared to 14,857 in 24. Attached sales was 7,996 versus 8,326 the year prior, down 4%. So overall, the market didn't fall apart. It just stayed constrained. And that's the point I want you to take from this. Closings aren't down because demand just suddenly vanished. Closings are down because supply has been getting choked off. When fewer homes come to market and inventory tightens, the entire system slows down, even if buyer interest is still there, which it is. It clearly is. The next question is the one that really matters. Even with closings constrained, what happens to pricing? And what does it tell us to expect in 2026? So let's dive into this. Median price, essentially this scoreboard for the supply and demand story. Here's how things closed out and what to expect in early 2026. In December, the median sales price for detached homes came in at $1,050,000. That's up 5% year over year. And on the attached side, the median came in at $680,000, up about 3% year over year. Now, if we look at the full year, because this is the part that most people miss, year to date, detached is basically flat. 2024 was 1,050,000, 2025 was 1,050,500, essentially no change. Attached is also basically flat year to date, actually just slightly down. 2024 was 675 and 2025 was 670. So flat, but not flat. It's about a $5,000 difference. So what does this tell us? It tells us that pricing is holding up, but affordability is absolutely capping how far it can run. And honestly, this is exactly what we need in San Diego. We need prices to hold or to grow very, very slowly while income has a chance to catch up. If prices were ripping higher again, it would just widen the gap. Now, quick reality check on median price because this is important. Median is a really useful directional read, but it's not gospel. And when sales volumes are as low as they are, the median can get pushed around by the mix of what actually sold that month. If December happened to have a few higher end closings than normal, it can lift the median even if the typical home didn't suddenly get more expensive overnight. The same thing goes the other way as well. So I'm not using this number to say that every home is worth more. I'm using it to say pricing overall is still holding up in a market where supply is tight and buyers are being selective. Now, when you tie this back to what we just covered, it makes total sense. New listings fell off a cliff late in the year. Active inventory compressed hard. Months of supply dropped back towards 2021 levels, and pending stayed surprisingly resilient. When supply tightens like that, prices don't usually collapse. They stabilize, and that's exactly what the data is showing us heading into 2026. All right, now let's look at the total market overview. This is the combined detached plus attached picture, and it's basically this scoreboard for everything we just walked through. This will give us a good idea of the direction the market is going into the first quarter of the year. In December of 2025, we had only 424 new listings hit the market, and that was down 72.4% year over year. At the same time, we had 1,354 homes go into escrow, and that was down 1.4% year over year. We closed out 1,673 homes in December, which was down 6.3%. And the median sales price came in at $901,000, up 3% year over year. Now, looking at what we ended the month with, we finished December with 1,876 homes for sale, which is down 50.6%. And the month of supply is sitting at 1, down 50% year over year. So if you want the simplest way to describe December, it's this: supply got cut in half, demand didn't. That's why it felt tight. That's why buyers were frustrated. And that's why pricing stayed firm, even with affordability still being the real and most prevailing problem in this market. Now, looking at the full year, 2025 ended with 32,894 new listings, up 4.1%. Total pendings for the year was 22,907, down 1.3%, and closed sales were 22,739, down about 2%. The median sales price for the year was $900,000, up only 0.3%, which is basically flat, and that's exactly what a constrained market looks like when affordability is doing its job as the speed limit. So, heading into Q1 of 2026, I don't expect some big wave of inventory to suddenly hit the market. We're probably gonna see normal seasonal improvement, but a flood of listings would require a meaningful shift in seller behavior, and we just don't have any evidence of that yet. At the same time, buyers haven't disappeared. They're still here, and a lot of them are just waiting for the right home to pop up because late 2025 was just slim pickings. My expectations for Q1 is that prices are gonna hold pretty steady, not because everything is booming, but because supply is still structurally tight and demand is still hanging around. Then, like we typically see, demand tends to pick up between March and May. And if mortgage rates drift down at all, that only adds fuel to the buyer pool. Either way, I'm gonna keep tracking this and bringing you the data so you're not guessing based on the headlines. And that's a wrap. I hope this update was valuable and helpful for you to get a better pulse of what the market is doing here in San Diego. Be sure to like and subscribe if you haven't already. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.